Dividend investing is one of the most popular and most straightforward investing strategy that I know. It's clear, it's simple, you get paid, you can get the dividend snowball, everything seems perfect. So why so many investors lag behind the market or suffer from dividend cuts or quit altogether dividend investing to go for ETFs? That's because dividend investing is full of traps. And there are things that you may are doing right now that will put your portfolio to fail in the future. Today, I'm going to identify 3 of them, and I'm going to also provide you with the solution. So let's start with the first one, industry focused. This one is particularly true for Canadians. They love their turf. What is turf? Well, a classic investment strategy that focuses on telecoms, utilities, REITs, and financials. As you can guess, they're all great dividend payers there. You're going to get good yield, and Canadians tend to focus on those industries. To highlight my point, I'm going to focus on Canadian banks today. Of course, I love Canadian banks. They actually have an incredibly strong moat. They operate in an oligopoly that is federally regulated. In other words, they cannot even go wrong because the federal government is going to set the rules in place. They have a very stable model, generating a ton of cash flow coming from their Canadian activities and opening the door to expand into other products and other services along with other countries. Some of them have been paying a dividend for over 100 years. So what's the problem? What's the catch? Why should I not invest 40% of my portfolio in Canadian banks, right? So imagine this scenario for a moment. Imagine there are tariffs everywhere, and then a lot of small businesses are forced to default on their commercial loan. Imagine that there is a higher unemployment rate across Canada, and therefore consumers have to also default on their personal loans. And imagine that this economic slowdown created by tariffs and higher unemployment rate, well, brings us to a housing crisis where a lot of people default on their mortgages. Do you really think that it's a good idea to have 40% of your portfolio in that single industry? Probably not, right? So a good argument would be, but Mike, I don't know which company will be better. I don't know which bank will be better. So therefore, I'm having all of them to make sure that I invest in the right Canadian bank. So you know what? Canadian banks are not created equal. If you look at the performance of Scotiabank, for example, since the great financial crisis of 2008, you will notice that the bank not only underperformed behind the rest of the market, but greatly underperformed behind other Canadian banks. The thing is, Canadian banks now have different types of strategies. Some of them are working, some of them not so much. And keep in mind, Scotiabank skipped the dividend increase on top of that. So you may argue with me that they have been paying for decades their dividend. Well, right now it doesn't even protect you against inflation. So if you focus on specific industries, what's going to happen is sometimes specific events are going to deeply impact those industries, putting your portfolio at risk. What's the solution? Well, this one is quite simple. Protect your portfolio against yourself. I know that you love Canadian banks. Well, just go for diversification. Take the top 2, maximum the top 3 of each sector. And how do you determine the top 2 or the top 3? Well, focus on companies with a strong balance sheet and robust financial metrics. I am using the dividend triangle to identify which company is better than other. So by focusing on companies with the ability to grow their revenue, grow their earnings, and grow their dividend better than others in the same industry, I'm easily able to select companies based on facts instead of selecting a company just based on a great story. Reason why dividend investors fail, number 2. They think that growth equals volatility, and therefore they discard all low yield, high growth stocks. I often hear, well, I get the dividend no matter what happens on the stock market. It brings stability, and low yield, high growth stocks tend to be super volatile. Well, when people think that, they actually think about companies like Peloton that doesn't even pay a dividend, and yes, it is quite volatile. But what brings the volatility is not the low yield or the high growth potential, it's actually the hype around a specific stock. We clearly see how Peloton got a big hype during COVID, and the rest is history. So a good way to know if a company has a higher volatility than another is to look at their average beta. The beta is quite simple. If it's above 1, it tells you that the stock price will move with a higher amplitude than the rest of the stock market. So therefore, will be more volatile than the market. And between you and me, the stock market sometimes, it's quite volatile. A beta under 1 will tell you that the stock price will fluctuate in a smaller manner versus what the market does. So if the market goes down by 5%, a lower beta will show a lower drop, and if the stock market goes up by 4%, well, the same has to happen. So therefore, the stock price will tend to not go up as fast as the 4%. So to show you that the low yield, high dividend growth stocks are not necessarily companies with more risk or more volatility, I pulled out a few companies from the stock comparison at Dividend Stocks Rock. This stock comparison tool helps me to compare any type of companies across US, across Canada, across many sectors, or even industries. Or in this case, I just wanted to look at companies with a strong dividend triangle. So you can see the numbers at the bottom. We have companies like Alimentation Couche-Tard, Waste Connection, Dollarama, and Stella Jones. They all show a lot of revenue growth, a lot of earnings growth, and of course, generous dividend increases. But when you look at their beta, they're all below 1. Actually, interestingly enough, Waste Connection is at 0.64, Dollarama is at 0.45, and Stella Jones at 0.48. In other words, those 4 companies are less volatile than the stock market. So what happens if you do the same thing and you look at companies with a higher yield? So companies with a yield above 4% that are known to be steady dividend payer. So I decided to select Enbridge, BCE, Canadian Natural Resources, and Scotiabank. As you can see, the beta goes from 0.43 with Bell, which is quite impressive, right? Very stable business, to as volatile as 1.83 at Canadian Natural Resources. Ironically, when you look at the dividend triangle metric at the bottom of this graph, you will notice that the only one above those 3 that has a strong dividend triangle is Canadian Natural Resources, the one that is more volatile. So in other words, there are not necessarily a conclusion here to take for granted that not necessarily low yield, high growth stocks will have a low beta or the opposite, but just to tell you that discarding companies based on yield is a big mistake. While you do not reduce the volatility of your portfolio, you may increase the risk, because if you just focus on companies with yield, thinking they're more stable, well, you're also selecting companies with weaker dividend triangle that could lead to some losses and also, of course, dividend cuts from case to case. Speaking of low yield versus high yield, I want you to download the Dividend Income for Life guide that will explain you the yield dynamic. So what I mean by that is I'm going to explain you in this guide why a company is forced to pay a high yield or a low yield, and you will be in a better position to make the right choice for your portfolio. I also include a list of stocks that I would buy today, showing that low yield, high dividend growth perspective. And finally, I'm also showing you how to use this strategy when you retire. So you can download the Dividend Income for Life guide at dividendstocksrock.com/income or use the link in the description below. Reason number 3, the most important reason why dividend investors fail is because they fall in love with a stock and its yield. I have to go back to BCE story for one more time. Why? Because the yield is amazing, right? So over the past 5 years, the company went from paying a high 5 to 6% yield all the way up to 12 right now. And then I hear a lot of investors telling me, well, I don't mind, Mike, if they cut the dividend by half, I'm still going to make 6% on my investment. Well, the 6% yield is not exactly what's happening right now. If you had invested $10,000 in BCE 5 years ago, that $10,000 is not worth $5,000. So yes, you're getting a 6% yield, assuming a dividend cut of 50%. but you only have half of your money in your pocket on top of that. So a dividend cut seems imminent on this one, but on top of the dividend cut, you're going to lose a lot of capital. Do you really think that Dell's going to come back? Well, that's another problem. A lot of investors, they fall in love so deeply that they forget about the metrics and the facts that are behind a company. So let's go back to the story in the first place. Why those investors have fallen in love with Dell? Well, there are a lot of things to love about Dell, actually. It's a major player in the wireline and wireless industry in Canada. People need smartphone more than ever. They have invested greatly in 5G technology that will bring a lot of cash flow. They even try to expand in the US with the acquisition of Ziply, which is actually going to fuel more cash flow into the company. And finally, in 2024, they cut down their expenses, laid off people. They are a leaner company, and therefore, once again, cash flow is going to flow in and everything, all the problems are going to be solved. So, I love to look at the investment story and then back it up with facts. So I want to look at numbers. So let's take the fourth quarter results of 2024 that was just reported earlier in February. On this one, and I've told you many times over the past 2 years, for telcos, same story with TELUS, you must monitor cash flow metrics. So here we have at the bottom of this chart, cash flow from operating activities that is down 21% year over year. That is not great because it means that it generates less cash flow than it used to. Capital expenditures, so the amount that they're actually spending to maintain their wireless network and to grow the business, is actually a little bit lower. So that's a good thing. It went from $1 billion to $963 million. And finally, the free cash flow, so the money that is available to pay the dividend or to do anything else, well, it's actually down 32%. Not looking good, right? So those are like the basic facts. If you dig a little bit deeper, then it gets even more worrisome. A quick look at the Q4 earnings financial statements will show you that interest charges has jumped by 18%. Operating cash flow, as I mentioned, was down by 21%, free cash flow down by 32%, and the dividend paid up by 2.5%. Most importantly, the company is paying more dividend than it generates in free cash flow. What does that mean? It means that the company will have to gather more debt to pay that quarterly payment. What do you think is going to happen at one point when you keep on borrowing to pay a dividend? Well, the CEO won't care anymore about your precious dividend and it's going to cut it off. And this is pretty much what the market is trying to tell us by dropping the stock price by 50% over the past 5 years. There is, once again, a reason why BCE is paying such a high yield. And it's not to be generous and it's not to be cool. It's actually because the company is struggling. So falling in love with a good story and a good yield will not help you achieve your retirement plan. Actually, quite the opposite, it's going to destroy it. So the solution for this problem is quite simple. Always make sure that you back your investment thesis with real numbers, with facts. When it doesn't happen, well, give your company maybe 2 to 3 years maximum to recover and to go back in growth mode. And actually, you need to see a real plan that is developing over every quarter that you monitor a company. If it's not the case, well, shorten the time that you're willing to wait and get rid of it as quickly as possible. Actually, I followed that own investment rule to sell one of my top 10 stock not too long ago, and I will explain you why and what I've done it in the next video next Thursday. So if you don't want to miss it, just make sure that you subscribe to the channel and you like this video so you get the notification when the next video is up. So to wrap this up, there are 3 major reasons why dividend investors fail with their portfolio. The first one, they focus too much on a single industry. The solution is to have a better diversification. The second reason why dividend investors fail is they think that low yield, high growth stocks equal volatility. Actually, the solution is to focus on financial metrics and not discard stocks based on yield. Finally, falling in love with a company with a high yield is quite dangerous. The solution for that is always to, when you have a very strong investment narrative, well, make sure that you also have a very strong financial metrics to back it up. So, all right, guys, that's enough for today. I want to see you in the comment. Let me know what you think about those 3 reasons, or if you have any other reasons why dividend investors fail. I'm going to see you in the comment. And until the next video, don't forget to stay invested.